We're going to be looking at revenue. I'll share my screen shortly. The topic for today, the word of the day, is revenue. Right, revenue is the accounting standard IFRS 15. It is not a very old standard. It's a fairly new standard. So by that, I mean it shall be tested in the test, obviously, because this test is about IFRS 15. And in the exam again, we're going to find it. So you cannot escape it. You just have to what? To know it. That's our accounting standards, IFRS 15. So we have to know what is it that is expected of us as far as IFRS 15 is concerned. Now, this is what you do when you start in standard. At this level, it's about competence and technical ability. So how are those determined? By your ability to read the standard, interpret the standard, apply the standard in questions. Yet you're going to find someone trying to know about the standard, trying to go into the exam and answer in the exam and pass the exam without going through the standard. That is not possible. I would say it now. Or just believing that we did enough in class. That is semi-possible. So you have to download the standard or not. Yes, if you are doing 30 year, you have to download the standard. If you are doing a CTA, you have to buy the IFRS book. Because you can't be an accountant who has never bought an IFRS book, who would say, I've been using general knowledge. I got here through general knowledge. That will never happen. If you have survived in the past, you're not going to survive here. That was your card. So you need the standard. And you're going to suffer because you'll be basing everything on empty information, which may not be sufficient. Because what is your memory MB, megabytes? Very small. It's not enough. So you need the standard. 30 year, download it, read it. CTA, buy the book, read it. etc. Okay. So we have to go. Right. Learning outcomes at the end of the day. So this standard could be right. We are starting this standard. So our learning outcomes also, they are going to be detected by the what? They're going to be detected by this standard. Okay, here is the standard, IFRS 15. It goes like how? Contents. Objective. What is the objective of the standard? Right? Meeting objective is scope. Is scope, we are saying, when do we apply the standard? So there are instances in which the standard can be applied to certain cells, maybe, and then there are instances where the standard cannot be applied. So we must know when do we apply it and or what is covered by this. Recognition, which is the main thing now. This standard looks at the recognition and measurement of revenue from contract, recognition, measurement, presentation, and disclosure of revenue from contracted customers. That is the objective of this particular standard. At the end of the day, we must be able to say if revenue can be recognized here or not. And we must be able to measure at what amount is the revenue supposed to be measured to be recognized in the books. And we must know how to disclose revenue in the financial statements. In this case, it's going to be in the profit or loss. And then finally, it will teach us how to disclose the revenue in the annual financial statements. That's the objective. That's what we are trying to achieve. And that's what you must have in mind. Don't think that this standard is going to teach you something which is out of this world. No, it's going to teach you those things. And that's what I'm going to take you through. Only that. So, because most of the causes of failure is that students know that they have to learn to get a promotion, they have to learn to stay ahead of their juniors. But what is it that they should do when after registration? They don't have an idea. How they should study, they don't have an idea. Because you might have studied with conventional universities in your undergrad or other previous qualification. Then you say, now I'm working, I need to correspond. How the correspondence is done may not be known. Then we have problem. Then we have other challenges. Sure. So we are here to bridge that gap. Right. So basically, these are your learning outcomes. This is what we're trying to achieve. So if you go through all this now, it means that you will be in a position to say, I understand my IFRS 15. I can answer any question on IFRS 15. I am ready on IFRS 15. Sharp. I will start by scope. This is very key for your understanding, conceptualization, having an idea what you're trying to achieve. Let's go to the scope. The scope, we are saying, what does it cover? But when we get to scope, I think it's going to make sense. An entity shall apply this standard to contract with customers, except. So whenever I've got a contract with customers, you have to apply the standard. But this standard is not going to apply in the following instances. They list the instances. Number one, list contracts within the scope of IFRS 16. So if IFRS 16 and IFRS 15 cannot coexist. Contracts with the scope of IFRS 17, which is insurance contracts. Among insurance company, they do not apply IFRS 15. They apply IFRS 4 and 17. Financial instruments and other contractual rights or obligations within the scope of IFRS 9, IFRS 10, IFRS 11, IFRS IS 27, IS 28. In those standards, we don't apply IFRS 15. Non-monetary exchanges between entities in the same line of business to facilitate sales to customers or potential customers. For example, this standard would not apply to a contract between two oil companies that agree to an exchange of oil to fulfill demand from their customers in different specified locations on a timely basis. If you've got an oil company in Zimbabwe, an oil company here, there are different companies, right? And then those companies say, you know what, I've got a buyer, a South African company says, I've got a buyer in Zimbabwe. Then a Zimbabwean company says, I've got a buyer of oil in South Africa for the same literage. What if when in Zim, you give my buyer the oil there, and me this side, I give your customer the oil that side. So they say in that instance, IFRS 15 will not apply. But what is the probability of them asking you such a nonsense in an exam? The probability is remote. The probability is 0. Maybe, if you're lucky, they can ask you that. Sure, that is the scope. Now, this kind of questions, they normally ask them, the questions around the scope, they normally ask them around ITC and APC there. And so they will normally say, okay, a new accountant is in the insurance business, he's just wondering if they can, how to account for revenue from contracted customers, which standard should they apply? You need to say that now. Definitely IFRS 15 is out because the scope of IFRS 15 does not cover insurance contract. Any other standard should therefore be considered. And that standard is IFRS 17 or 4. Just that. 5 marks in the bag, you move. All right. So there we are. That's where we are as far as the scope is concerned. Okay. Do we have definitions here? No, we don't have definitions. Recognition. 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 So here we write. Let's go. If it's 15. Scope applies to contracts with customers other than those contracts covered by IFRS 16, IFRS 17 or 4, IFRS 9, IS 27, etc. The truth there to the standard. Yeah. Right. Recognition. So the accounting standards that we study with people, they tell us how to account for something. Tell us how to account for something. So if this 15 is going to tell us how to recognize inventory, sorry, a sale. If this 15 provides 5 steps for revenue recognition, it provides 5 steps for recognition of revenue. To say that now, how do we recognize revenue? What are the boxes that must be ticked in order for us to recognize revenue? What must be present before we can recognize revenue? It gives us those things that must be present. And the exam is around that. Let's look at it. 5 steps for revenue recognition. 5 steps for revenue recognition. It's what we start next. Okay, let me take this call. Maybe someone trying to join back. Oh, okay. Sorry. Someone is trying to download the so right. 5 steps. 5 steps for revenue recognition. All right. Now, good people. Accounting, it's about recognition, measurement, and disclosure. Like any standard, it will speak to recognition, measurement, and disclosure of something. So even exams are going to come around that. Are students able to say when to recognize something, how to measure something, and how to disclose something? So as we embark on this journey of IFRS 15, you must know what is it that we are trying to achieve. We are trying to achieve those three. To know when to recognize revenue, how to measure revenue, and how to disclose revenue. That's what we do. You mustn't see this as some funny animals. What are we trying to achieve after all? We're trying to achieve that. So IFRS 15 provides the 5 steps for revenue recognition. When we go to disclosure again, I will tell you about the disclosure. It is in. Okay. Right. Step number 1 is that before you can recognize the revenue, you must identify the contract or contracts with a customer. Right. Must identify a contract or contract with the customer. Right. Step 2, good people. We're going to explain these steps. Identify the performance obligations in the contract. I'm a performance obligations in the contract. Step 3, I'll explain this contract, these steps first at high level before we can go into detail. Determine the transaction price. Step 4, allocate the transaction price to the performance obligations in the contract. Step 5, recognize revenue when or as the entity satisfies the performance obligations. Okay, let's first talk about this like we are not in class, like we are not serious about it. Sure. So we said before we recognize the revenue, in terms of IFRS 15, you must have ticked all those 5 boxes. Let me say boxes instead of steps. You must have ticked all those 5 boxes. Meaning to say, there but one table, that now there must be a contract with the customer. Identify something that is there. There must be a contract with the customer. A contract of sale in this case. The contract of sale, good people, remember, it can be explicit or implicit. Explicit would have a document, a contract of sale signed by both parties. I'm buying furniture from you. I'm buying this from you. We are buying water from you. We are buying cold drinks from you. That's a contract with the customer. It must exist. Implied or implicit contract, this one is seen by the what? It is seen by the intention of the parties, like buying a newspaper. You go to buy a newspaper from a newspaper vendor, what do? You hand over the money and he gives you the newspaper. Even you can do that without saying a word. Still, a contract with the customer would have existed from the perspective of the vendor. He handed the money, I gave him the newspaper. It's a valid contract of sale. Sure. So once there is the existence of a contract of sale, we are happy with step 1. We now have to consider with step 2. With step 2, it says identify the performance obligation in the contract. Identify the performance obligations in the contract. What do we mean by that? We are saying, talking from the perspective of an entity, remember when you do IFRS 15, you're going to be talking from the perspective of the entity and not the customer. So the performance obligations in a contract, in the case of an entity, is going to be to deliver the good or to provide a service. Let's say, guys, you are paid for these classes. My performance obligation would be to provide the tutorials, to revise with you, etc. That would be performance obligations. They have to be identified. So if it's a scenario, then say, from the given contract, from the given scenario, the obligations of the entity are as follows: to deliver impalers, to deliver water, to deliver bricks. Sure. Determine determine the transaction price. So this one, determination of the transaction price with step 3 is to do with the measurement. Remember we said e-accounting is the recognition measurement. So this is the measurement part. With step 3 and 4, they speak to the measurement. Determine the transaction price. Now we are determining the transaction price. That newspaper, how much is it sold for? The tutorials, how much do they amount to? How much are your classes? Then we determine, the classes are going to be 1.5, 2,000, 4,000, 10,000. Okay. We are doing the what? Determining the transaction price. Step 4, allocate the transaction price to the performance obligation in the contract. Now, in the case of our promise as classes is to provide demo tutorials and the revision for a price of 3,000. So the next thing would be for us to say, we gotta allocate this 3,000 to the 2 performance obligations. Because the performance obligation here is not like one. In the case of tutorials, we can say the performance obligations are as follows: to provide classes, tutorials, and to conduct revision with the students for their exams and tests. So that being the case, when the performance obligations are more than 2, then we have to allocate the transaction price to the performance obligations. And we normally do that using the standalone selling prices. So the allocation of transaction price to performance obligation, it works where we are providing a bundle of goods and services, not only one. If it's only one, we simply say whatever is in step 3 applies in step 4. But if we are providing a bundle of goods and services, different performance obligations for a price of 1, it is then that IFRS 15 wants us to allocate the transaction price to different performance obligations. That's what it means. Okay, I'll give you a simple example there. A simple example. Okay, let's stick to our tutorials. And the allocation of transaction price to different performance obligation, or step 3, it is done using the standalone selling prices. We use the standalone selling prices. I'll give you an example of tutorials. You come here, you say, how much are the tutorials? We say 3,000. We say 3,000. And then you say, that's the transition price. What is it that you're going to provide me with? It is going to be what? Our performance obligation. To say that now, in this class for 3,000 that you're going to provide us, Tell me, what is it that I'm going to get out of the 3,000 that I'll pay? I'll shall go through the syllabus with you. That is, I'll provide the tutorials and revision. So now I've got different performance obligations. Transaction price has been determined. Or my performance obligations, remember, they are the ones that you have to determine first. Step 2. These are my performance obligations. Step 3, determine the transaction price. Step 4, allocate the transaction price to different performance obligations. So now I need to allocate the transaction price to the different performance obligations. But I wouldn't have had the stress if I promised you only one thing, tutorials, and charge you 3,000. My step 4 was going to be the easiest because the allocation of the transaction price, the 3,000 that I charge you, which is for tutorials, will be allocated to tutorials. But if I promise a bundle of goods or services, it is then that step 4 becomes active. How then do I allocate the 3,000 to the different performance obligations that I have? That's what you have to do. So the answer to that is that the transaction price, is allocated to different performance obligations using the standalone selling prices. Remember, I said we've got two scenarios here. If I'm providing one service, I'm at tutorials only for a price of 2,000, then with step 3, determine the transaction price. The transaction price is 3,000, being the cost of the tutorials. Performance obligation step 2 is to provide the tutorials only. Step 4, the allocation of the transaction price to different performance obligation. I would say there's one performance obligation for this client, for this customer, for this company, which is to provide tutorials for a price of 3,000. The entire 3,000 is allocated to the provision of the tutorials. It becomes easy allocating the transaction price if you're providing one good or service. But where a bundle of goods or services are provided for a price of 1, that's when step 4 becomes active. Because now we would need to allocate the transaction price using the standalone selling price. It's a different goods or services offered for a price of 1. How do we do it? We use the standalone selling prices. So now for me to allocate how much will go for tutorials as a portion of this, and how much it will go to revision as a portion of that, I need to find a transaction price, a standalone transaction price for each. And now, why are we doing that? It is because when we recognize revenue, we shall recognize revenue for the performance obligations that we have fulfilled. For example, the portion that relates to tutorials, I have to recognize it as soon as I'm done with the syllabus. But the portion that relates to revision, I need to pause it until I've revised with you guys. So that's the reason why we need to allocate a transaction price to different performance obligations. It is for the purposes of recognizing revenue for that part of the performance obligation which we have fulfilled at a specific point in time. Well, step 5 is the one that drives step 4. So now to allocate this price, now I need to come and say, all right, the student might come and say, all right, let's say I only wanted the tutorials, but I don't want to revise with you guys. I need to go and do revision with another college. How much will you charge me? Then we say, no, for tutorial it's 1.8. Yeah, ma'am. Okay, another student will come and say, okay, gents, Mina, for a syllabus, I'll cover it on my own, but I'll need to come for tutorial. How much will you charge me? You say 1.2. So effectively, if you add, oh, no. It doesn't have to be exactly like that, yeah, right? Normally, if you're buying it as a bundle, it becomes cheaper and discounted. So basically, this is a discounted price. So what that would mean is, let me give a whereby I must tell the non-selling price they sum to more than the price of the oil. So let's say here, but Jim, we say a student comes say, how much are the tutorials? Say, tutorials only is 2.5. How much are the revision? Revision alone is 1.5. And it means that now the cost of that combo is 4,000. But if you want a revision and tutorials with us, we'll charge you a price of 3,000. Obviously, it's going to be effectively discounted. So step 4 now is saying allocate the transaction price to different performance obligations. So we allocate using our standalone selling price. It's some simple math literacy thing. This is a standalone price, right? This is a standalone price. This is the transaction price with it down. And then this becomes the what? The allocated price. So we allocate the prices so that at the end of our tutorials, I have to recognize the level for the tutorial classes and recognize a liability for the revision because I'm yet to revise with you. So to allocate here, I need to say, using standalone selling price, high school maths literacy, I will simply say for tutorials, tutorial price, standalone price divided by the total, multiplied by 3,000. For the revision, that divided by that, multiplied by 3,000. So this year becomes my what? This becomes the allocated price. So it means that for each student, after I'm done with classes, I need to recognize an amount of 1,875 from the fee you would have paid because I've discharged my performance obligation. And then this one is going to be carried as a contract liability because I'm yet to provide tuition. I'm yet to revise with you guys. Right. So that's the purpose of that step 4. So be able now as a learning outcome to allocate the transaction price to different performance obligations. They will bring an issue of a car that is sold under a maintenance plan because a car is going to be provided at a point in time, but a maintenance plan is going to be provided over time. We need to allocate the transaction price to those two performance obligations so that now for the vehicle that we sell to you, at the point that you take it, we recognize that revenue because the risk and rewards have passed through. But for the maintenance plan that is going to be rendered to you over a period of time, we recognize part of it as we meet our performance obligations. That's the reason, good people. That's the reason. Let's go for an example. Let's go for an example. Here is an example. Okay, this company has got a year end of 28 February 2013 year end, 28 February 2018 year end, and the Selama Sports Cars. Now, the question here, it was saying what to these people? It wanted a journal. not 2. The question wanted us to prepare journals. So I'm trying to demonstrate with step 4 because that's where if is 4 is, if is 15 is. Now here's the question. It's got a 28 February, and it says it's required. Prepare all the necessary journal entries for additional information to above in the accounting records of Boxer Limited only for the 2028 financial year. Sure. On 1 February 2013, a month before year end, Boxer sold a layman sports car, including a service plan, for $750. So they gave us a price for $750. I want to use this, but okay. So that when I speak, I'll speak as I do, like a television. Television. So here we are saying, let's say we don't have those figures, we don't have those figures. And they say they are selling a sports car. Right. On 1 February 2013, Boca Limited sold a layman sports car, including a service plan for $750. So here we are selling a sports car. It's not tutorial. $750. So the company has got 2 performance obligations in this case. Cash. One, it is to provide a sports car as well as the maintenance plan. So I did step 2. These are step 2. Identify the performance obligations. We have identified them. It is those 2. Sure. These cars are sold at cost plus 25%. A customer may also acquire a layman sports car without a service plan for $730. So now this is a standalone selling price for a sports car, $730. Boxer Limited regularly sells 2-year service plan to customers for a standalone selling price of $25,000. For a standalone selling price of $25,000. I come here. Standalone selling price for a maintenance plan, $25,000. There we go, guys. So if you buy them separately, this is how much you pay. If you buy them as a combo, the effective price is going to be that much. Let me call this person and find out something. So you can be going through that and trying to see what we'll do. This is our step 4 demonstration. Okay, hey, someone disturbance. A lot of people didn't download the Zoom and. All right, sure, let's continue. Right. So this company, if I'm to apply this one, if I'm to discuss this question, step number one, identify the contract with the customer. Yes, a contract with the customer, they exist. A contract with the customer exists as Ulayman is selling a sports car to a customer, an identified customer there. Sure. Then we come to step two now. Identify the performance obligation in the contract. We have got two performance obligations. There are two performance obligations in this contract, which are number one, the sale of the delivery of a sports car, as well as the provision of the maintenance service or the provision of a service plan to this customer. Two performance obligations are identified there. We could. Then we go. Step step three. Step three, it says that now identify the transaction price, determine the transaction price. You would have to come here and say the sports car is sold for an amount of 750. Sorry, the sports car and the service and the maintenance and the service plan. It's a combo price. And the service plan are sold for an amount of 750. Just that small English. You move on. Step four. Allocate the transaction price to different performance obligations. How do we allocate? We use the standalone selling price. So now we need to come here and identify the standalone selling price to say that now, if we are to buy a sports car separate, if we are to buy a service car separate, how much are we going to pay? They provide that for us. They say it's going to be 730 for a sports car. It's going to be 25,000 for a maintenance plan. And then now we need to allocate this using those ratios. If I put my amount there, remember we've got our formula. We have allocated our transaction price to the two performance obligations. So the car now, when sold as a combo together with the maintenance plan, is actually sold at a discounted price of 725,166. The maintenance plan, when it's bought together with the car, that is when it is bought as a combo, it is going to be actually bought for 24,834. Keep in mind, good people, that this service plan is a 2-year service plan. Now, we are required to provide the journals. How do we do these journals? The journal for the revenue, I can split. Let's say I'm a slow learner. I don't want to come up with a combo journal. Can split, sell, but I won't be able to split because of e-cash. Sell of the sports car. My revenue is going to be like this. Sorry, we are receiving money from the bank. That is not the doubt. 750,000 hits our bank account. But now, how much do we recognize as revenue? This will call for step 5. We recognize revenue for the performance obligations that we have satisfied. What are the two performance obligations that we have satisfied? We have satisfied two performance obligations. Let me refer to the working year. In 2013, we satisfied two performance obligations, which are sale of the car. Yes, everything that relates to process from the sale of the car, which is allocated to the sale of the car, we recognize. And then we need to come here and say service plan. The service plan portion now, that's where you need to think. Are you going to recognize the full amount of 24,834 in 2013 when the service plan has to be rendered over a period of 2 years? No. You only want to recognize the service plan portion that relates to the current year or 2013, which is the service plan portion for 1 month. So now I have to come and say 24,834 divided by, this is for 2 months, for 24 months, because for 2 years, divided by 24. Then I say multiply by 1 month because I want to recognize a service plan only for 1 month for the month of February because the car was made with 1 month to year end. Then I do this. This is what I recognize as 11. This is what I recognize as revenue for the period. This is what I recognize as revenue for the period. But now if you check, our journal is not balancing. It is handicapped. We have got an issue. What are we going to recognize here to make our journaling? What are we going to recognize there? It is that portion of the service plan which we have not satisfied. That is the portion for the service plan for 23 months, which we are yet to deliver. For 23 months, which is going to be delivered in the future. Which is going to be delivered in the future. And we refer to it as what? We refer to it as contract liability. I am going to take you through the definition of terms as well. This is going to be referred to as a contract liability. It is a contract liability. How so? Because it is what was previously referred to as income received in advance. But that was IS 18, the old standard for revenue. The new standard for revenue, IFRS 15, refers to revenue received in advance as a contract liability. Then we are good to go. We have our journal there. Right? We have our journal there. So that's the activity in step number 4, good people, when you are doing the allocation of the transaction price to different performance obligations. This is what we'll be doing. Step 4. Step 4 is busy. Step 4 is busy. That's where most of the exam is gonna be. That's where most of the exam is gonna be. Okay, so in Linda. Right, so there is a journal here for cost of sales again, but let me not talk about it. A journal for cost of sales. We're gonna talk about it some other day, but now. There is your example. There is your answer. Sharp. Step 4, allocating the transaction price to different performance obligations. Okay, are we able to do that? Do we understand, good people?
Yes, we do.
Yes, that's where a lot of things are found with step 4. All right, it doesn't end there. The story goes on and say, recognize revenue when or as the entity satisfies the performance obligation. So the reason, the purpose of allocating our transaction price to different performance obligations is so that we can recognize revenue for those performance obligations that we have discharged. And then recognize the contract liability if we have been paid for those obligations that we have not discharged. So this was basically our step 5. It says recognize revenue for the performance obligations that you have fulfilled. In this case, as at the reporting date, the vehicle had been delivered. As at the reporting date, the maintenance plan or the service plan for 1 month has been executed. So recognize revenue. And then for that which you have not satisfied this performance obligation, please raise a contract liability. And we did exactly that. So IFRS 15 is about this. If you're able to take me through the steps, if you're able to tell the examiner about the steps, then you're good to go. Recognize revenue when or as the entity satisfies a performance obligation. Yes, so that's where we are. That's where we are. Thereafter, now we then just go to the nitty-gritties of the standard. But this is what we're going to learn. And then subsequently, later on, you then learn about other things, or contract liability, or contract don't. But this is the foundation of everything. Why? We are able to recognize a revenue by applying the 5 steps of revenue recognition, measurement. We are able to do step 5, step 3, determine the transaction price. We are able to do step 4, which is the what? Allocate the transaction price to different performance obligation. Okay. So there we are, good people. All right, let's go and see now. Now you're going back to the steps, looking at each and every steps to bring this home, to internalize the stuff. All right. So in your exam now, when you're answering those questions, like for instance, identify the contract with the customer. How are you going to conclude that a customer with a contract with the customer exists? They will run us through that. How do we see that a contract with the customer exists? They say, an entity shall account for a contract with the customer that is within the scope of this standard only when all of the following criteria are met. When all. So if you tick all the following boxes, box in A, B, C, D, and E, the conclusion that is going to be drawn is that a contract exists with the customer. So because now the exam question is going to say now, discuss if the entity should recognize revenue under the following circumstances. Then they say a newspaper vendor or a passerby handed money to the newspaper vendor and the newspaper vendor handed the newspaper to the passerby. Discuss if that activity should be accounted for in terms of IFRS 15. Then you need to run with it. You have to identify the contract with the customer. You need to tell us if there is a contract between the passerby and the newspaper vendor. And then you're going to say that a contract between the newspaper vendor and the passerby exists if all of the following criteria are met. Number 1, the parties to the contract have approved the contract in writing, orally, or in accordance with other customary business practices, or are committed to perform their respective obligations. They've approved the contract. Think about the written contract of sale of FAC4862 or written contract of sale or buying of something from ShopRite or the newspaper vendor stories. If I hand over money to you, you take it and you give me the newspaper, I go. There's been an approval. If there was a disapproval, we're going to be fighting and say, why are you taking my money? Why are you giving me the newspaper? But the fact that I handed the money and you gave me the newspaper and I went, that's approval. So in the case of that simple example, we would simply say that the first criterion is met because the two parties approved the contract. The money was handed to the newspaper vendor. He accepted the money, and the newspaper vendor handed the newspaper to the passerby, and the passerby accepted the newspaper. Therefore, the two parties, from what we are seeing, from the circumstances, it is presumed that the two parties have approved the contract. Another criteria that must be met. The entity can identify each party's rights regarding the goods or services to be transferred. Each party's rights. So what are each party's rights? In the case of that simple example, the newspaper vendor has got the right to receive consideration. And on the other side, the passerby, he has got the right to receive the newspaper from the vendor for the consideration that was paid. Let's go. The entity can identify the terms of payment for goods or services transferred. In the case of that simple example that I said there, the terms of payment can be identified. This is a cash sale. No. You apply that. In terms of the payments can be identified. This is a cash sale. D, the contract is commercial substance, i.e., the risk timing or amounts of the entity's cash flows is expected to change as a result of the contract. So the cash flows of the vendor is going to change as a result of this transaction. The cash and cash equivalent in his pocket is going to increase with the cash and cash equivalent or consideration received from the sale of the newspaper. Therefore, the contract has a commercial substance. Okay, let me slow down. What does it mean to say a contract has got a commercial substance? Okay. Okay. So a contract must have a commercial substance, is it? Like in the case of maybe general terms, if maybe something was sold at a loss, that's when we say, this one is trick. Why would someone sell something at a loss? What benefit do they derive? When we talk about commercial substance, it must make commercial sense. Normally, the underlying cause of going into business, make profit. Sure. So that one will say, hey, the contract has a commercial substance because the seller will receive consideration for the newspaper sold. But if it was given for free, if someone was passing by, then the vendor stops them and gives them a newspaper. Then they say, discuss if that activity should be accounted for in terms of IFRS 15. It was going to fail in D. That A, though that the other party accepted the newspaper, there was approval of the contract. But this contract, it lacks commercial substance because the newspaper was given for free, for no consideration. So what commercial benefit is the vendor deriving there? Zero. Right, Asamben. It is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred. It must be probable. In this case, requirement E is met as this was a cash sale, the consideration was received. Sure. Then all the requirements of saying that a contract exists are met. Therefore, the newspaper vendor should recognize a revenue. So Now, when they say discuss the 5 steps of revenue, apply the 5 steps of revenue recognition in a given scenario, that's what you're going to be testing goal number 1, step 1. That's what you'll be testing goal number 1. And you must know, how do I test if a contract exists with the customer? This is how you do it. If you leave out some of the elements, the AMA requirements, but still conclude that a contract exists, disappointment. Won't know they are demonstrating that when you are a naturally lazy person, or you are demonstrating that you can't do anything to me. We wonder. All right. Right, then they go on there and say, okay, we have been too serious. Let's take it light. They explain to you what a contract is. All right, now they're taking it easy. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Enforceable rights and obligations. Then they say, contracts can be written, signed the contract of sale, oral, word of mouth, pick and pay, can I have a time? Implied by the entity's customary business practices. For instance, the buying of a newspaper is a good example of an implied contract. You just hand over the newspaper money, you take the newspaper that you want, get the change, you go. But the newspaper stories are slowly dying away. A lot of newspaper companies are closing down because of internet. Internet is not giving them a chance. Dear female. Sharp. Let's go to step. Okay, they're going to talk about some stuff there, which I'm not going to touch now. Otherwise, we end on step 1, but you can go and read there. Step 2. But when we formally start, we'll go through those. Step 2, good people. Let's learn about step 2. We are approaching this like we don't know anything. You might be knowing there, but let's just know it for the purpose of this 15. Identify performance obligation. If we say 50 says, at contract inception, an entity shall assess the goods or services promised in a contract with the customer and shall identify as a performance obligation each promise to transfer to the customer. Either the same entity must identify what is it that they are promising the customer. Like I say, when you write a tutorial, we must identify what is it that we are promising you, what is it that you are paying for. We can't just take your money and say, hey, classes, 3,000, pay. We must identify what is it that we're going to promising to deliver to you, and we must do so. Otherwise, you sue us. So they say entities are required to identify. Right? What are they required to identify? A good or service, or a bundle of goods or services. That is distinct. A series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. So we must understand what is it that we are promising you. Are we promising you one good or one service? Are we promising you a bundle of goods and services? We must know that. And this is very important now, because when you go to step 3 or 4 or so, we need to allocate the transaction price to different performance obligation for step 4. So now, if you did not identify your performance obligations, the allocation becomes difficult, because you're not going to identify the performance obligations, and there are various standalone selling price for the purposes of allocating the transaction price. So this is very key, right? So I touch on that one. That's what matters. So now they will define to you what is a distinct good or services. Because sometimes the offering of tutorial classes and the revision and all that, can be seen as one thing. For instance, if a revision or tutorials cannot be paid for separately. If like you come here, we say, how much are your classes? I say 3,000. What is it that is covered in that 3,000? It's summer classes and tutorials. What if I only want tutorials? If I say, no, we don't do tutorials only. What if I want revision? No, we don't do class revision alone. It means that what we are promising there should be seen as a distinct code, should be seen only as one service. It mustn't be seen as a bundle of goods or service. So the entire price is going to be allocated there. We are offering, in other words, we are promising one, we have got only one performance obligation. So that's what you would learn there. So in the case where there is one performance obligation, then none. There's no challenges when it comes to allocation. But the entire price will go there. Asambe. Next. Oh, this one, it will talk about certification of performance obligation. Right.
Remember, sir, can you perhaps maybe explain again the distinct part? I did not get that then.
Or it distinct code, is it? All right. Now, when a company is selling something, it can either sell a bundle of goods, right? Did they come? It can either sell a bundle of goods or it can sell a distinct good, right? Now, I'll give you an example. If it's a bundle of goods, you are paying for a couple of things for a price of one. Like in that case of a sports car and maintenance service. That was a bundle of goods because it is two things that can be sold separately. It's a bundle. Two things that can be sold separate, but they were sold for a price of one. Maintenance plan, service plan, a sports car, they were being sold for $750. And each of those items in the bundle, they can be sold separate. So if you hear that each of the items there that is being offered can be sold separately, so it means that those things that were sold for a price of one, they are a bundle of goods. But if that question said that the service plan and the motor car, sports car cannot be sold separate. So we have to see a service plan and the motor vehicle as one thing. Do we get it now?
Okay, if they cannot be sold separately, then are distinct. I want to get that.
Yes.
Okay. All right, no, it's fine. Thanks.
Okay. Then now we go to the next thing there. They talk about certification of performance obligation. How are the performance obligations satisfied? They can be satisfied at a point in time or over time. At a point in time or over time. And I'll need to explain that. Satisfied at a point, a performance obligation certified over time, can be satisfied over time, or they can be satisfied at a point in time. They should have started with at a point in time because it is. If a performance obligation is satisfied at a point in time, it means that contract is extinguished at a certain point in time. For instance, if you go to ShopRite, you buy bread, you take bread, you give them cash, that performance obligation is satisfied at a point in time. Done. Take your bread, give them money, case closed. But if, like, for instance, it's in the case of a tutorial, the performance obligation is satisfied over time. I'm going to be with you all the way, February, all the way to write your first test in April, there, June. So what I'm saying, you're going to receive it over a period of time there. It's not like I'm with a class, if you're talking about class, you come to class, I teach you, done. We're not going to see each other again for that same price. Or if you have to see each other again, it'll be for a different price. So over time, it means that the obligation is discharged over a period of time. Someone is building you a house. the performance obligation is going to be satisfied over time. I'll say foundation, window level, roof level, plastering. The obligation is satisfied over a period of time. But if you're buying a complete house, that obligation is satisfied at a point in time. I hand over the cash, you give me the keys, done. So that's something that you must know under this part of step 3, yes. Okay, so we move on to the next one, which is, okay, this is for the one for the performance obligation over time, which we're also going to be talking about it. That if your performance obligation is satisfied over time, how do we do it? Like if performance obligation that is satisfied over time, I can remind you on the service plan. That is a performance obligation that is satisfied over time. Measurement. Remember I said recognition, measurement, and disclosure. So the first two way to do with recognition. The measurement now is 3 and 4. Right. Determine the transaction price. This is our step number 3. Determine the transaction price. This transaction is being entered into for how much? That's all that we are saying. Case of class, the transaction price is 3,000. The entity shall consider the terms of the contract and its customary business practices to determine the transaction price. The transaction price is the amount of the consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, like a VAT. So a transaction price, this is consideration expected to be received from a transaction. Simple. But it does not include amounts paid to third parties, like a VAT. Then there are things that you're going to cover there, amendment, small things underneath that, sharp. Then you can then highlight on this part 04. Allocation of transaction price to different performance obligations, which is key, the what is normally tested. Okay. Allocating. If you're offering one distinct code, which is not a bundle, is like in the case of maybe bread, allocating the transaction price to different performance obligation. How many performance obligations do we have? It's 1. How much is the price of bread? 20 rand. That 20 rand is allocated to the sale of bread. But if there are many performance obligations for a price of 1, then we need to allocate those different performance obligations so that we can recognize the revenue for the performance obligations that we have finished. Like if you go back again to our example, that vehicle, I had to do it then so that now you will have something to visualize as we go along. Going back to the story of the vehicle, there were 2 performance obligations there because those 2 are distinct goods that were sold as a bundle. So we had to find some basis. We had to use some standalone selling prices to allocate the transaction price. Yes. We had to do that. Sharp. The objective when allocating the transaction price for an entity to allocate the transaction price to each performance obligation, that small max, or a distinct code in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or service. Okay, the allocation, good people, it is based on standalone selling prices. And I've demonstrated that part. And I believe now that we are able to allocate our transaction price to different performance obligations. I'm happy there. Right, and with step 5 also, we have also done it. With step 5, I showed you. With step 5, step 5, they didn't put it separately. Recognize revenue as and when the entity satisfies those performance obligations. I don't know why they hit that one. Step 5, they didn't explain it. But this is also your homework to go and look at the definition of these terms. But with step 5 now, it says recognize revenue as an recognize revenue when or as the entity satisfies performance obligation. So here we are simply saying, for what we have, for the performance obligation that you have extinguished, like in this case, the sale of the vehicle, case closed, recognize revenue. For the service plan for 1 month, because the period of 1 month has passed, recognize the performance, recognize revenue for that. And for the service plan for the remaining 23 months, because you have not provided the service plan for those months, do not recognize revenue, but raise a contract liability for that. All right. So that is the story, good people, there of IFRS 15 in a nutshell. This is just done to bring you closer to me. But we shall dive inside the what? The standard further. We are going to look at other things like a contract costs. We are also going to look at other things like our past questions. So, but for now, as an introduction, what I'm encouraging you to do is please know the full cycle. Be able to explain those particular be able to explain those particular steps roughly the way you understand it. I'll be more than happy. Each step, good people, it's a class of its own, kind of. Each step is a class of its own. Don't say revenues is. So when we formally start now, we'd say, all right, today we are looking at how we identify the contract with the customer, of which you now have got a clue. We come again next day, we are looking at how we identify performance obligations in the contract. And then, of course, step 3 and 4 combined in one day. And 5 as well. We just make a 2-hour class. We close those off. Then we go to something else. But this is where we stand today. There we stand. Any questions, good people?
I think we're fine there. Thanks.
Okay. All right. Sharp, sharp, good people. We'll meet again shortly.
So
Bye.
are you going to send these recordings?
Oh, yes, yes, yes. All the recordings, end of day, I'll be sharing them.
All right, no, thanks.
Okay.
Sure.
Sure.
Thank you.
Thank you. Bye.